Distinguished guests, members of faculty, and my fellow future managers, a very good afternoon to all. Welcome to the first day of Conventus 2016, the annual management conclave of IMI New Delhi. I, Anuj Bansal, and my co-compare Neha Joshi will take you through the session of Finance Club of IMI. This year, Conventus is structured around the theme Transforming Corporate India, Transcending Innovation Towards Strategic Sustenance. India today is in uncharted waters with never-seen-before growth in the business world and with the increasing number of startups, SBUs, and subsidiaries adding to the burgeoning number of businesses in the country. Innovation is no longer sufficient for any business to survive, let alone to be able to thrive. Corporate India needs to strategize its vision for the future with sustenance in mind. With a multitude of companies now offering the same product, offered earlier by just a few, it is understandable that the life cycle has considerably reduced. However, this shouldn't be taken as an excuse to give up, rather as a challenge to overcome. All that needs to be done is to strategize the corporate world in whichever way it suits businesses such that they transcend beyond innovation and enter into the realm of strategic sustenance. Hence, the industries should prepare for the long-term survival in today's fast-changing and constantly evolving market space. Before we proceed further into the session, let us have a look at the Conventus video.
The topic for discussion in this session is Transforming the Indian Financial System for Sustainable Development. With growing momentum behind efforts to link finance policy and sustainability across the world, there is no time to lose in India. Over the next 5 years, India faces one of the world's biggest challenges, ending financial untouchability for 100 million families, bringing clean and affordable supplies of water and energy to all of its 1.3 billion inhabitants, and investing in the enterprises that will provide livelihood for an extra 10 million job seekers each year. Fixing financing needs incrementally in a piecemeal manner would not be sufficient in the context of scaled-up targets. There's a need of a paradigm shift which would come from creating a sustainable framework for the financial sector that would change the rules of game for the financing institutions and create the appeal for sustainable financing. Harnessing the power of financial innovation could be the key here. The role of green ratings, peer-to-peer lending, green bonds, infrastructure investment, trust model, guarantee and credit enhancement mechanisms, etc., needs to be explored in order to draw in private capital for the sustainable development. To give us more insights into this topic, we are honored to have amongst us 5 very eminent personalities. Mr. R. Balachandar, Mr. Bimaldeep Singh, Mr. Manoranjan Sharma, Mr. S.K. Zutshi, and Mr. Sanjay Kumar. To give us more information on today's session, I would like to now call upon Ali and Smriti from the organizing club to make a brief presentation on the session.
Esteemed panelists, respected faculty members, and fellow future budding managers, I, Ali Rizvi, along with my colleague Smriti Singh, on behalf of the Finance Club, welcome you all to the Finance Summit of Conventus 2016. Now, we would like you all to see the video of our Finance Club. As we all know, the panel discussion will revolve around the topic transforming the Indian financial system for sustainable development. Now, Smriti shall talk about the present scenario of the Indian financial system and the challenges it faces.
To achieve the objectives of sustainable development, India has a huge pipeline of investment projects encompassing critical sectors like sustainable agriculture, clean energy, efficient buildings, mass transit, smart cities, clean water, and waste management. However, unlike many other developed countries, Indian corporate sector is yet to make a significant mark in these sectors, the prime reason for which is financing challenges. The discussion aims to address challenges like increasing access to multilateral finance in order to plug the fiscal gap in sustainable development-related expenditure, improving private participation in financing infrastructure projects, and implementing weather-based insurance schemes in a better manner. Moving on to the next topic, responsible banking. China faces urgent environmental challenges such as climate change, habitat and biodiversity loss, air and water pollution, water scarcity, and desertification and erosion. In 2007, China's Ministry of Environmental Protection and the China Banking Regulatory Commission jointly announced the Green Credit Initiative, under which the environmental performance of loan applicants must be taken into account by the bank. Loan applicants with poor compliance records are required to pay higher interest rates, and serious violators are denied credit. The guidelines also show the banks how to integrate sustainability thinking into their lending cycle and will be applied to all lending, both domestic and overseas. Sustainable finance instruments such as environmental regulation and standards are important tools in providing incentives for sustainable development in any country or region. The next topic of discussion would be the role of green bonds to draw in private capital for sustainable development. A green bond is like any other regular bond, and the money raised by the issuer is earmarked towards financing green projects, which means assets or business activities that are environment friendly. Such projects could be in the areas of renewable energy, clean transportation, and sustainable water management. With an increasing focus of foreign investors towards green investments, it could also help in reducing the cost of capital. In 2007, green bonds were launched by few development banks such as the European Investment Bank and the World Bank. Axis Bank is the only bank which has launched green bonds amounting to rupees 1,000 crore in the year 2007. In order to leverage effective green bonds, few steps can be implemented, like removal of withholding tax on external commercial borrowings, which is currently set at 5%, and extension of cash reserve ratio benefits as in some incentives.
The next topic would be infrastructure investment trusts. The infrastructure investment trusts are trusts that manage income generating infrastructure investment assets. INVITs can invest in infrastructure projects either directly or through a special purpose vehicle. In case of public private partnership projects, such investments can only be through SPVs. INVITs are regulated by the Securities Market Regulator in India, the Securities and Exchange Board of India, and are expected to encourage higher foreign investments in the Indian financial sector, whereas reducing the burden on the banking system as well as allowing developers to unlock the tied up capital. The next topic would be peer-to-peer lending. It is a method of debt financing that enables individuals to borrow and lend money without the use of any official financial institution as an intermediary. RBI has proposed registering P2P lending platforms as NBFCs. There are around 30 startups in the P2P lending business which are working in India. Money has to move directly from the lender to the borrower without any escort account. Now, there are certain advantages to it. There are the loans generate income in the form of interest, which can often exceed the amount of interest that can be earned by traditional means. Gives borrowers access to financing that they may not have otherwise if they have gotten approval for by standard financial institutions. The next would be Asset Quality Review RBI Guidelines. A special inspection was conducted in 2015-16 in the August-November period, wherein big sample size large borrower accounts were inspected to check if classification was in line with prudent norms. If not, banks were asked to treat them as non-performing. The need would be, it is much needed as the asset classification was not being done properly and the banks were resorting to evergreening of bonds. They proposed bad loan classification. The impact was record losses in Q4 of financial 16 by many large lenders like Bank of Baroda amounting to 3,230 crores, Punjab National Bank amounting to 5,000 crores, IDBI Bank amounting to 1,300 crores. The doubtful assets attracted 40% provisioning under these guidelines. If loan was not serviced, banks have to treat it as a loss account with 100% provisioning. Thus, we can see that how inevitable and integral it is to transform our financial system to cater to our sustainable development needs. We hope for an enriching discussion. I would now like to invite Anuj and Neha to take the stage over.
Thank you so much, Ali and Smriti. Now, since we are in such august company, I would like to take the privilege to introduce each of our panelists to you people. Our first panelist is Dr. Manoranjan Sharma. Dr. Manoranjan Sharma, he is the General Manager of Canara Bank. He holds a first-class bachelor's degree, first-class master's degree in economics, first-class postgraduate diploma in business management, and a PhD. He has over 300 publications, including in the Business Review, Cambridge, occasional papers, RBI Mumbai, Bank Quest, Cap Calling, Professional Banker, Analyst, Yojana, The Indian Banker, the Economic Times, and Business Line. He has presented papers at several national and international conferences and delivered keynote addresses at various universities. He has widely traveled both India and abroad. Dr. Sharma has made presentations and chaired sessions at conferences organized by Marcus Evans, Malaysia, Terrapin Private Limited, Singapore, Naseba, Paris, Max Planck, West Germany, Indian Institute of Science, Bangalore, and World Association for Sustainable Development, London. He was the keynote speaker at the International Conference on Frontiers at Infrastructure Financing, IIT Kharagpur, in the month of November 2014. He was also a panelist at 4 International Finance Conference at IIT Kharagpur in the month of November 2014. He was a discussant at the International Conference of Housing, Financial Stability and Growth, jointly organized by IMF and IIM Bangalore in the month of December 2014. His book, Global Economic Meltdown, and 5 edited books, that is, Leading Issues in Indian Economy, Studies in Money, Finance and Banking, India's Transforming Financial Sector, Dynamics of Indian Banking, and Indian Economic Policies and Data have been widely acclaimed. His views have been cited in the Parliament, the Associated Press, New York, Dow Jones, New York, International Herald Tribune, New York, Wall Street Journal, New York, and the Economic Times. Sir, we are privileged to have you with us today. As a token of our respect, we would like to present you with a bouquet. And may I please request Professor Barnali Chakradhar to kindly do the honors? We welcome you, sir.
We welcome you, sir. Our next panelist is Mr. R. Balachandra. Mr. Balachandra is a fellow chartered accountant and a management graduate. He has over 20 years of experience in conducting management advisory assignments and audits, mainly for large corporates both in the private and the public sector. His core industry specialization is in the financial services sector, that is, insurance, banking, mutual funds, AMCs, and term lending financial institutions, etc. His international experience includes short-term secondment to the insurance group of Ernst & Young, UK. He has earlier worked in London for 1 year with a leading city-based accounting firm specializing in insurance. He has also provided expert financial management inputs for a management consulting assignment in Dubai. Mr. Balachandra is also the IPO leader for EY India and is extensively quoted by the media on IPO-related matters. In addition, he heads corporate services for EY India. Sir, we are privileged to have you here with us today. As a token of our respect, we would like to present you with a bouquet. May I request Professor Prashant Gupta to kindly do the honors.
We welcome you, sir. Our next panelist, and it gives me great honor to introduce him, is Mr. Bimaldeep Singh. Mr. Bimaldeep Singh is an alumni of IMI. He is a senior banker having worked in financial sector for the past 15 years. He currently works with Deutsche Bank AG India as a director and senior relationship manager in the corporate and investment banking team covering large Indian conglomerates, including Reliance MDA Group, Tata SR and SL Group. Before moving to banking, Bimal has also worked with the leading Indian corporates, including Reliance MDA Group and the SL Group, and has helped these institutions raise large ticket project financing for their various group initiatives. He is based in Mumbai. Sir, we are privileged to have you with us today. And as a token of our appreciation, may I please invite Professor Sanjay Dhamija to kindly do the honors and give the bouquet to you. We welcome you, sir.
Thank you.
Our next panelist is Mr. Sanjay Kumar. Mr. Sanjay Kumar is the Senior Director in Deloitte, India. He is responsible for transfer pricing, advanced pricing agreements, mutual agreement procedure projects, and tax policy initiatives, including on BEPs. He has master's degree in economics from the State University of New York, Stony Brook, USA, mathematical tripos from the University of Cambridge, UK, and a master's degree in physics from the University of Delhi, India. He is a member of INTAC and a prestigious Indian Institute of Public Administration. Mr. Sanjay Kumar was earlier with the Indian Revenue Service and took voluntary retirement as a Principal Commissioner of Income Tax in 2015 after 28 years in the government. His last assignment in the government was Secretary of Tax Administration Reforms Commission. Earlier, he worked on many key assignments, including Commissioner in the CBDT, Ministry of Finance, and Regional Commissioner for International Taxation and Transfer Pricing. He was also a member of the 5 dispute resolution panel at the different places in the country. He was on many expert committees of the government, including in committees on black money estimation and revenue forecasting. He is an IMF impaneled tax administration assessor and has done international consultancies on tax reforms. Mr. Sanjay was India's trade negotiator for 3 years at the WTO in the areas of IPR, SPS, TBT, and trade and environment. He also participated in a number of bilateral trade negotiations. Mr. Sanjay has been a senior fellow and adjunct professor of public policy at Duke University, USA since 2007, teaching courses on international tax and transfer pricing. He has published a number of papers on tax, transfer pricing, trade and industry issues in reputed international and national journals. Sir, we are privileged to have you with us today. As a token of respect, we would like to present you with a bouquet. And may I please request Professor Aman Srivastava to do the honors.
We welcome you, sir. I would now like to introduce Mr. S.K. Zucchi. Mr. Zucchi has an experience of 39 years in the banking sector. His academic qualifications include M.Com, MA in Economics, LLB, CAIIB, and professional qualification in Capital Market and Mutual Fund. He started his career with Punjab National Bank in the year 1980 and since then has worked with various offices in the area of operations at ECE House, New Delhi. At present, he is the Circle Head South Delhi zone of PNB, covering over 100 branches. He has also worked at the Shanghai branch of PNB for over 5 years for banking business development and has been working as a head of various companies. He specializes in the field of international banking and has worked as manager and at senior level in rural, semi-urban, urban, metropolitan, and international centers. He has also worked as Senior Vice President in subsidiaries specialized in corporate advisory services and mutual fund asset management trust for over 10 years. He has also been a part of corporate restructuring and NPA management apart from specializing in areas of foreign exchange. He has also been the Zonal Head Bhopal region for a period of 2 years prior to being the Circle Head South Delhi zone of PNB. Sir, we are privileged to have you here with us today. As a token of our respect, we would like to present you with a bouquet. May I please request Professor Deepak Tandon to kindly do the honors.
Come up. Deepak and me, we have worked 10 years together, so it will be like this. It is on behalf of all my future bankers and future entrepreneurs. Thanks so much. Welcome.
We welcome you, sir. I would now like to introduce our faculty moderator for this session, Professor Deepak Tandon. Professor Tandon is a professor in finance at IMI New Delhi and has 33 years of work experience. He has a PhD in Management, Finance and Banking from Washington, D.C., MBA in Finance from FMS Delhi University, LLB from Delhi University, MSc Delhi University, CAIIB from Indian Institute of Banking and Finance, Mumbai. He has been a visiting faculty at SRCC Delhi University, SP Jain Mumbai, IMT Ghaziabad, ICAI, ICWAI, and other allied Premier B schools. He has also taught at University of Luton, Bedfordshire, Sassoon University, Bangkok. He has worked for various banks like PNB, PNB Capital Services, Vaisya, J&K, IndusInd, and Oriental Bank of Commerce at the level of Vice President, Senior Faculty, Forest and Risk Management. He is an approved ISO lead auditor from Nigel Bohr and Associates, Germany, IRCA certified auditor. He has authored well over 104 research papers duly published in leading international and national finance journals and periodicals. He has also been a chairperson, keynote speaker at various national and international conferences. He has also been a chairperson. He is an editor-in-chief for Asian Journal of Research in Social Sciences and Humanities and on the editorial board of several journals. He has also authored 7 books in the areas of forex management, strategic management, risk management, retail banking, Indian banking, emerging issues in finance and banking, and has taken several prominent workshops for senior managers at Bank of India, PNB, FEDAI, NTPC, etc. Dr. Tandon has been awarded a gold medal termed Jewel of India Award and Vidya Gaurav Gold Medal Award from Indian Solidarity Council, New Delhi, and International Institute of Education and Management, Mumbai. He is also a recipient of Lifetime Achievement Award from UGC-sponsored RIMT Mandi Gobindgarh and from DAV Institution Board, Punjab. He is a life member of the Professional Risk Managers International Association, Wilmington, DE, USA, Kolkata chapter, and an affiliate member of Global Association of Risk Professionals, New Jersey, USA. He has received the Best Professor in Financial Management Award at 22nd Devang Mehta Business School Award in 2014 at Mumbai. He recently published a book titled Management of Banks, Text and Cases from Taxman Publications Private Limited. Sir, we are privileged to have you here with us today. As a token of our respect, we would like to present you with a bouquet. May I request Akash Gupta, Secretary of Finance Club, to do the honors. Without further ado, I once again welcome all the guests and request Professor Deepak Tandon to initiate the session.
Okay, it's okay. A very good afternoon to you all, respected panelists, dignitaries from the corporate world, my dear faculty members, and nonetheless, my dearest students. I welcome you all to this Finance Summit. A little brief about this, how it went about, is when the topic of the Conventus was given by the students, and very aptly they chose transforming the Indian financial system for a sustainable development. Then the choice of the speakers from the Finance Club with an able mentor, Dr. Aman Shrivastava, finalized all the panelists and the dignitaries who are present on the dais. I know most of them, I met them, I worked with them, and without further wasting the time, I just straight away come to the panel discussion. Being the moderator, let me just tell the panelists the rules of the game. Okay, the rules are very clear that about 15 minutes each they will be given for their deliberations and the knowledge to our students. There will not be any cross firing or any questions in that. Let them deliver their thoughts, value additions, knowledge giving, preachings, and blessings to the students. After that, each and every panel number 1, panel number 2, panelists 3, 4, 5, and in between, I'll keep on moderating it and telling the times. After that, let there be a cross discussion and it will be an open house discussion. And once we are going to wind up, in the end, all the questions which you have for any of the panelists, just jot down, raise your hand, and it will be answered to the justice. In the end, I'll request one of my faculty members, Dr. Barnali, to just sum it up and give a vote of thanks to the panelists. That's how the 2 hours we are going to spend. 15-20 minutes is a good time to just give the deliberations, and I wish all the success to all the panelists for giving all the thoughts. To start with, I'll just give a saying, a quote from Pope Francis. The finance overwhelms the real economy. The lessons of the global financial crisis, which were spoken in the deliberations were done by our learned DG sir in the morning. Innovation and sustainability was the key area. And the chief guest also deliberated on the innovations, ideations, and in the Indian context, he just talked about the Jugaad Academy, right? So in that, finance overwhelms the real economy. The lessons of the global financial crisis has assimilated, and we are learning all too slowly the lessons of the environmental deteriorations. So the key objective is that we have to have a sustainable development, innovations, technological upgradation, and we must have a DMS route. What is DMS? Digitalization, socialization, and the mobile banking. So we'll devise our sessions into two ways. One is the financial system from the banker's perspective. We have two very able, very senior bankers with us. And after that, we are going to have from ENY and Deloitte. There are two again panelists and another from a foreign bank. He is going to give about the energy sector. What is the renewable, what is sustainability. So we sum it up in a altogether total forum of the Lions. Just a background which has not been dealt is why we chose this. 2015 has been a new year altogether of a sustainable financial system altogether. We have mobilized the capital. More and more policy innovations came into the capital market, insurance and investments, and a green area was emphasized. Corpus also has been allocated US dollars 16 trillion, and second part is the resilience part of it, and the third is your reduction of the externalities. US dollar 5 to 7 million for the infrastructure investments has been allocated by the UNDP report we are talking. And 2016, we have learned the lessons from the 2015, and a year of scaling has been taken up. Green finance strategies have been developed. Just to start, first of all, I would like to call upon the senior panelist, Dr. Manoranjan Sharma, who is a chief economist and the principal of Canara Bank Training Center. He is an economist, he has a balance sheet cell, he has worked, and a lot of years he has spent. Not to just take his time, overview, I have requested him to talk about the various areas, and I'll put him straight away the question, sir. You can just sum it up, would be, first of all, we are seeing Indian banking bleeding. We don't have manpower. What do you think? I'm just giving you the questions straight away so that your deliberations can come up. What are the right set of the people you think would be required for the financial system? Number two, India as on today is on a growth model. We are still hovering into 7 to 8% GDP. We want to go to 10%. How it will be achieved? What are the macro, despite we have got good macroeconomic indicators. The macroeconomic indicators which are there, GDP at the minute 7.4, Forex US dollars $350 million, CAD has come down, the deficit, rates are also coming down, fiscal deficit is in our power, and a new government policy by the Modinomics, Indianomics, which is coming, is the FDI route has been opened up. ECB also has been there. So, sir, I will request you the second part you can look into. I will not ask you to straight away do the demographic dividends, but the banking sector, potential investment, what are the basically your views that how you tap the young generation for the banking. So just to highlight, we have got a BFSI sector also, and a lot of students are there from the banking sector. This year we have got about 66 students in the banking sector who will be taking their prospective jobs into the banking sector. The next question which I will be that how will you repose your high performance companies, corporates vis-a-vis the banking sector? There have been a breakdown in the business sectors. Banks have bleeding, and today's newspaper talk about the mergers of the State Bank group, barring the State Bank of Hyderabad and the other one is the State Bank of Patiala. The others are undergoing a swap ratio, share exchange ratio, that too 2:22 or something like that we are doing it. The last question which if you want to sum up, would be the infrastructure financing which is there, the triple P model, what are the defects, why is it not coming up? And in the end, sir, I would request you to tell us something about your views how to transform the financial sector reforms. I know I have given you a lot to talk about, but I know you can do the justice with your versatile overall experiential summary which you have got from Canara Bank, and the board level you have already worked, sir. So I request you to just deliver all your deliberations hovering upon these points. Welcome, sir.
My fellow distinguished panelists, Professor Tandon, faculty members at IMI Delhi, distinguished guests, friends, ladies and gentlemen. At the outset, I am thankful to Professor Tandon and the organizers for having me here with you. I think Professor Tandon has made my task a little simpler. This is a topic which has huge ramifications, wide repercussions, but as requested by him, I'd focus on certain specified, identified issues. India on a high growth path. Let me try to place this issue in some kind of a proper historical and comparative perspective. We achieved independence way back in 1947, embarked on a process of planned economic development in 1950. The basic objective of planning in India in terms of the first 5-year plan was defined as raising the standards of people consistently. Over a period of about 30 years, this central objective of planning could be translated, could be subdivided into 4 basic objectives of growth, modernization, self-reliance, social justice. I think other things are by and large clear, but modernization needs a little bit of elaboration. When we see modernization, when we, apart from the growth, which is a merely quantitative parameter, we also look at certain qualitative parameters, such as the structural transformation of the economy, reflected, for example, in the fact that when we achieved independence, when the planning process was initiated way back in 50s, agriculture used to contribute something like well over 50% to GDP. Over the years, over the course of last 60 years or so, it has dropped drastically, come down to levels of about less than 15%, 13.5, 14% or so. However, this is a process which is not unique to India. Some of you students may be aware that the United Nations consistently publishes cross-country data, time series data, empirical data of there are about 200 countries of all data. They are available in various United Nations publications. So this is a part of a process which is not unique to India. But in India, we find there are some features which stand out in the Indian context. Despite the drastic fall in the contribution of agriculture to GDP, agriculture still accounts for something like 60% of the people are employed. I would not say productively, but they are still engaged in agriculture. Another thing which you find which makes the Indian story slightly different is the fact that in most cases, the process of development has been from agriculture to industry to services. But in the Indian context, we seem to have leapfrogged from agriculture to services. Services now account for well over 60% of our GDP. In the last few years, there have been coordinated and concerted attempts, most recent being the Make in India campaign, Digital India, so many such things, increased sharper focus on micro, small and medium enterprises. Manufacturing accounts for something like 15%. We are trying to push up to 25% because of high employment elasticity, huge potential for employment. So those things are being tried to be corrected. The other part of the story of India on a high growth path would be that 1991 in several ways marks a watershed in Indian economy. There were several areas of great concern, areas like fiscal deficit had reached a level of about 12% or so. Inflation, we had runaway inflation, price spiral 12%. Forex reserves, by any benchmark, by any indication, they should be, in all cases, even in what we call worst case scenario, they should be sufficient to meet for our needs for something like 6 to 8 months. they had dropped to an all-time low of about 2 weeks or so. In this kind of situation, perhaps we Indians have a bad tendency. I think there was a story in Economic Times yesterday that we resort to drastic measures only when we had no option. Something similar happened in 1991, and as events bear out, perhaps this was all to the good. So in the last 2 decades or so, India has consistently been an outperformer in the global economy. India and China, you go through any United Nations, World Bank report, reports of the International Monetary Fund, you will find that they emerged as some kind of a global growth drivers. Now that we find that there are several areas of concern to the Chinese economy, recent data from the IMF, the World Bank indicates that India is possibly the largest, fastest growing economy in the world. I would like your attention here for a moment. I'm not saying the fastest, largest, fastest. There are several economies which constitute a major part of the global economy, and among the large economies, India is certainly growing, with China slowing down. We have the World Bank's statement that with global growth slowing to about 2.5% or so, India has consistently achieved a growth rate of about 8%. This year, we're likely to end with 7.5, 7.6. We had also crossed 8% not too distant past. Before the October 2008 global financial meltdown, global financial crisis hit the global economy on a scale which was unprecedented, a scale which is comparable in many ways only to the Great Depression of 1929, 1930. So this was some kind of the magnitude, the severity of the crisis. Prior to this crisis, if I may jog your memory a little bit, you'll find that Indian economy was consistently achieving growth rate well in excess of 8%, 8.5%, 9%. And that time, the finance minister, Mr. P. Chidambaram, had said that we are very close to achieving double-digit growth. Well, we did not achieve that double-digit, but we came very close to it. Because of the ramifications of the global financial crisis, we were not hit directly for various reasons. I would not go into those reasons. But India was also affected by what we call the knock-on effects. Over a period of time, the GDP growth dropped down. We came to I think 2 years, we came to sub 5% levels. Now growth seems to be gaining traction once again. There are of course issues in GDP competition, but that has been discussed and debated at various fora, including the senior officials of the Ministry of Finance, the RBI governor, and other things, even at some international fora. But without quibbling over those points, without going into the merits, suffice it is to say that India seems to be back on growth path. We are likely to achieve 8%, 7.5% to 8%. There are differing assessments of the Planning Commission, Reserve Bank of India, Ministry of Finance, IMF, the World Bank. But by and large, there seems to be a broad consensus that India was well achieving 7%. So the World Bank president recently characterized India as the brightest spot in the global economy. Subsequently, she has reiterated this point of view in several interviews and several other presentations. I think Professor Tandon mentioned to BRICS, that is also an important. I think some of you, some students are very young, but perhaps you might remember that when the BJP government was in power in the earlier of something in 2003, they ran a campaign which was called Shining India campaign. Some of you might remember. Of course, the macroeconomic parameters that time were good. We had some kind of a virtuous cycle. But some kind of a theoretical foundation for this Shining India campaign was provided by a very important path-breaking report of Goldman Sachs. There was one Indian lady, Rupa Purushottam. There was one American gentleman. I don't remember his name at the moment. But they had propounded this theory of what they call demographic dividend, that India is a young country, bound to remain young for the next 30 or so years or so. And so it is going to reap the benefit of what they call demographic dividend. The young people would be a great asset, and I'm very happy to see so many young faces here in the crowd today. But in all these discussions and debates about the demographic dividend, BRICS report, Shining India campaign, perhaps we missed some elements. I would dare say some very important elements of the story. Perhaps we have an unfortunate tendency of picking up, grabbing headlines, not going into finer, granular details. And if you go into granular details, if you do for some kind of what we call a fine print analysis, you'll find that even in the BRICS report towards the last few pages, the entire report was about demographic dividend, the kind of place India is likely to occupy at the high table in the global economy. But they also, if you would have gone through the last few pages, that they also highlighted some important areas of concern. And to their assessment, unless those areas of concern would be addressed, India's demographic dividend, and this is my phrase, could well turn out to be a demographic disaster. I said demographic disaster because even the BRICS report highlighted areas of concern such as health, education, and employment. These are areas of great concern. They have been areas of great concern for the last 50 years. Perhaps we have made some headway in this area, but not enough. Professor Tandon also asked me to refer to the banking sector. There's been a great deal of concern about the present position of banking sector. There have been issues of rising NPAs at the industry level, what we call in the terminology of the Reserve Bank of India, scheduled commercial banks, that means banks which are listed in the second schedule of the banking RBI Act. The gross NPS level has jumped up to well over 10%. There are issues of capital, and in terms of Basel requirements by March 19, banks, of which public sector banks require capital infusion to the extent of about 2 lakh crore. Last few years, there have been some capital infusion through budgetary means, 25,000 crore this year, 20,000 crore. But obviously, given the scale and the magnitude of the problem, this is woefully inadequate. These issues have been well highlighted, but banking sector is some kind of a microcosm of the larger, the broader economy. And we do maintain, having seen things firsthand in the banking sector myself, discussions with large number of bankers and other financial experts, we do see light at the end of the tunnel. We are going through a difficult phase, certainly, but I am confident that with the kind of coordinated and concerted efforts being made, the banking sector will go places. It will take some time, it will take some doing, but we will be there. I find a lot of younger students, some of them might have some interest in banking in the financial world. I'm reminded of moving lines of William Wordsworth written possibly 200, 300 years ago. Bliss was it in dawn to be alive, but to be young was very heaven. So all of you are young, all of you are in that sort of what Wordsworth characterized as some kind of a heavenly position. The banking sector, the financial sector is in a strong and robust condition. There are areas of concern certainly, but there is no reason why going forward we cannot address these areas of concern. We have done them, we have addressed these areas of concern in the past also. For example, in the wake of the wide-ranging economic reforms process initiated way back in 1991, some of you who have some historical bend of mind, you do some kind of a data analysis, you'll know that the gross NPAs level had jumped up significantly. Most banks were forced to post losses, but we did come out of this position. The gross NPAs at that time, 91, reached a level of something like 15%. Our ROA, return on assets, has dropped to a level of 0.15%. 3 years back, our gross NPAs had come down to a level of less than 5%. At the industry level, our return on assets had reached the international benchmark of above 1%. Since then, in the last 3 years, because of the downturn of the Indian economy, because of the asset quality review, because, if I may say some plainly, something like the 2G, 3G, the policy paralysis which characterized the government at the center, there are several reasons. So things have taken a hit, but obviously, correcting them will take some doing, but we are on the right path. I think we'll overcome these issues. Mergers of acquisition in the financial sector, banking has been much talked about. There are issues of economies of scale, economies of scope. Most banks are on similar, if not identical, technological platforms. There are two basic FlexCube and Finacle. Banks are on the one on the other technology. So, but there are HR issues, there are issues of distinctive culture each bank has. So, the basic justification for merger stems from the fact that we don't find any bank in the top 100. There is a very respected publication from London, The Banker, which publishes in January and July every year the list of top 100 banks. To our dismay, we don't find any Indian bank. With the present process of mergers and acquisitions, greater thrust on consolidation of banks, I think we'd shortly be there. But let me submit that mergers and acquisition, consolidation in banking sector is not a panacea, is not a one-off kind of a thing to address all ills of the banking sector. For that, separate attempts should have to be made, focused attempts should have to be made. Infrastructure model, banks have played a very significant role in infrastructure development last 10-15 years. The kind of infrastructure development you find across the country, in most projects, banks have had a significant role to play. But this is again something which we find makes India's position distinctive, somewhat unique. If you look at the position of countries, there is absolutely no dispute on the fact that infrastructure is a basic prerequisite of development. However, there are wide differences of opinion on how to finance this infrastructure development. If you find if you go through the data analysis of various countries, you'll find that in very few countries of the world, banks have financed infrastructure development to the extent which you find in India. Mainly this infrastructure development would have been financed in most cases through what we call term lending institutions. We had some kind of a similar situation in India. If you go through old annual reports of IDBI, these institutions were characterized initially as what we call DFIs, Development Financial Institutions. And it was their mandate to focus on infrastructure development, large projects, capital intensive projects such as, say, let us say steel, iron, some such things. But because of this ongoing process of economic reforms, for example, even in IDBI case, there was a reverse merger with IDBI Bank, and for various reasons, there have been a focus of all the banks on the retail banking because the risks are diffused, the level of defaults and delinquencies is much lower, whereas, for example, if a housing loan goes bad, let us say if you take the example of a bank like Canara Bank or a PNB, even if you take a city like, let's say, Delhi, we find that the average ticket size of a loan is something like 30 lakhs. So if the ticket size is 30 lakhs, that means the value of the property, because we have this concept of what we call LTV ratios, loan to value ratios. No bank will give you the loan to the full extent, possibly about 80%. So that means if the value of your property is about 40 lakhs, you'll get a 30 lakh loan. We have collateral to back it, and there are other factors which make India's position slightly different, so that the kind of financial crisis which occurred in the United Nations way back, United States way back, will not occur. There are various, for example, if I may speak a little plainly, here there are strong emotional reasons. Without any gender bias, let me say that most houses are run by the women of the family. And in the Indian context, what we find is that by and large, there could be, of course, occasional differences. The females, the women have a very strong attachment to gold and house. So unless things completely out of hand, the lady of the house will not agree for a house to be mortgaged. Then there are several other factors. So housing has not, okay. So infrastructure model, but banks are not the right medium because banks basically have a lot of short-term funds. We have funds in what we call CASA funds. So this causes a huge mismatch in terms of assets and liability. This causes a maturity mismatch in what we call the language of the risk management. we have done our bit. Going forward, there are huge expectations from us on the infrastructure sector. We are still doing, but my submission to it that there are definite limits to what banks can do in infrastructure financing. There are other areas of concern. We have distinguished speakers on the banking sector, other sector, and I'm sure they will carry it forward. Thank you very much. Thank you.
Thank you, Sharma sir. In fact, he has given you everything on the banking sector. The takeaways are too many. Now, keeping this pace forward, I would still invite another very senior banker from Punjab National Bank, Shri S.K. Joshi sir. And my question, sir, deliberations, inputs to you as a moderator would be, what are the dynamic changes in the Indian banking sector which are taking place at a very fast pace? From 2014, we had about 45 banks. And 2016, we have got legacy banks added, more 45, universal banks, 2 more added, payment banks, more added 11, small banks 18. So now we are 66%. So every 2 years, we are seeing a transformational change and 45% increase in the banking sector. With, I think, Sharma sir also agrees that the mid-cap banks will be burnt out in the game. That is one of the things which is there. Now, my question to you would be, what has led to this triple R concept in the Indian banking sector? The triple R would be the robust banking, the responsible banking, sustainable, and the resilient banking. So that, number 2, sir, I would like you to share with the students your experiences. You have spent a very, very long time at Shanghai. So what are the Shanghai banks? China. Let's come to the straight away the statistics, which is there. China is number 2nd, India is number 9th. When we compare the triple P, the purchasing power, it is number 1, India is number 3rd. When we talk about the global wealth, China is 16.08, India is 23.16. And when we combine both the GDPs, everything, the total triple P, India plus China becomes 52.77. And as I was undergoing all the Harvard YouTubes with Chanda Kochar, Raghuram Rajan last night, I found that Indian banks are faring much better than the Chinese bank because the debt component in the Chinese bank is too big. I had problems presenting a paper in China last year, October. I went to a small village of China, that is Chengdu. We had an Indo-Shuaishan University. That license also you can touch so that the students have a feel of the international experience. Last question would be a very simple one. In your opinion, what are the various challenges which the Indian banking sector should take a forward leap for a sustainable economic approach? Welcome, sir.
Thank you, Deepak. Very distinguished and respectable panelists, respectable faculty members, and my dear students. Deepak, if you permit me, I will start from the last question. Then my job will be easy. Friends, I am a practical banker, student of economics. I will give you the practical banker view. Because theoretical books and all that you will read more than enough. But what the bankers see in my 39 years of banking, right from rural bank to international bank, where I have seen the crux of the problem is, I will be discussing with you. I will not go in the economic jargon. I will go to the direct banking and direct simple words where the problem lies and what are the challenges. Just 2 minutes I will speak on the financial sector. From, layman view, what is the financial sector? Financial sector has 3 components. One is the supplier. And who is the basic supplier? It is the banks, financial institutions, insurance, non-banking finance companies, all those together which are putting finance or some financial input into the market. Second part of the financial sector is the components, which is called the products. What are the products? We fund people, we take deposits from people, and we provide them various services, like insurance services. We add so many other now mutual fund services. These are the products which are available in the financial market. And third is the services part, where these services are provided in the financial sector. What are those services? Two of my very distinguished panelists are there, the consultants, the legal people, the brokerage companies, rating companies, which are providing the supporting services to take the financial decisions. This is where the entire financial sector lies. Then I come to the specifically banking sector, because the larger part of the financial sector is driven by the banks. Pre-1969, that is pre-nationalization, what was the characteristics of banking? They were simply class banking. They were servicing specific people, specific targeted people only. After nationalization, and particularly after 1999, when the government liberalized the banking sector, it became the class banking. From class banking, it became the mass banking. The entire people were covered. Poorest of the poor was connected to the bank. You have a question? Yes, not fully. But the banking doors were open to those also who were have-nots, who were not wealthy people, who were not really people who were earlier target of the banks. And present scenario, at present now, what we see in the banking and financial sector, it is banks are open for privatization. As my friend Deepak said, more and more banks are mushrooming from private sector. Then globalization. We are going abroad. Foreign banks are entering our economy. The Indian economy, they are opening all the major sectors, including banking, for the global world. And these days, what you are reading and what you are more worried and concerned about is what my earlier banker colleague said, that is consolidation. Now we are going towards consolidation. Nothing to be worried. These are different phases of the economy where you revolve the economy. The phases come and phases go. It is only the decision what the governments take, the monetary and the fiscal policy takes to make the economy more vibrant and to see that the financial sector is ready to serve the industry, ready to serve the economy for their targeted goal of the economic development, what they target, how much growth we should achieve. Now I come to the challenges. At present, the biggest challenge to the banking and financial sector is liberalization. How much liberalize? Whether domestically we should liberalize, internationally we should liberalize, in a protective environment we should liberalize, or it should be an open economy. Some thoughts you must have given to the current account convertibility, capital account convertibility. So many questions are there. For last 25 years, I am finding they are unanswered. Though they are addressed to a certain extent, but they are unanswered, not fully covered up. This is the biggest challenge, because we want to bring more and more people under banking umbrella. We want to reach the financial sector to each and every household. Earlier, entire industry was under the government umbrella. Now the government, don't have that much capital, they don't have that much of the funds and resources. Now they have to totally liberalize it so that it gives the maximum to the economy. Second important challenge is deregulation. Banking is totally regulated economy. We right from issue of a opening of a bank branch, transacting of a bank, their international operations, their funding, their lending, entire thing is regulated. So in this regulated environment, how much deregulation should be there? It is a very crucial debate going on in our monetary authority, Reserve Bank of India and the Finance Ministry, how much they should provide the deregulation, because deregulations have danger marks also, because sometimes they are abused and they are misinterpreted, and you feel so many frauds, so many misappropriations, so many different sort of economic embezzlements you read. So you must be reading in the newspapers almost daily, we have one or the other such type of a incident where we feel that certain regulations have to be put on. Third important challenge is globalization. As a practical banker, biggest hit what we have found is because of the globalization, acceptance of Basel norms. You all must have read about the Basel. The entire banking industry has changed. We have what Mr. Deepak said, bleeding balance sheets. They are because of the stringent global norms which we have put on in the banking industry in India. We were not prepared. The entire banking industry in India was protected by the government because it was a government-owned bank. We had a very, very minimal capital base. But after adopting the Basel norms, all the banks in India, they have to follow the global norms, capital adequacy norms, risk weight norms, which were not suiting to the Indian banking sector because our base was not in a commercial or what I should say, professional lines. It was purely a social banking. It was purely a government-driven banks. So this is the biggest challenge. Now Basel III, 2018, 2019, we have to make a drastic changes in our risk profiles, and you must be remembering that the newspapers, they say entire banks require at least 1.5 lakh crore rupees as a capital infusion from the government to survive, which is a big challenge at the present moment. The governments, they don't have that much surplus funds to put into the banking sector, which is hampering the growth of the banks, which is hampering the functioning of the banks, particularly the lending side is so much affected, and it has direct impact on the slow growth of the economy. It is a vicious circle, not coming up funds from the economy to banks, from the different various sectors to banks, and because of not generating more credits, not in the industry, they are not able to provide further credits, and the acceleration has stopped, where you feel that particularly after 2008, because of the global slowdown in economy, more slowdown has caused. For 3-4 years we survived, but later on now we are feeling the pinches of the slowdown in the economy, which you must be aware, reading that most of industries, they are worried they are not getting the right amount of credit in their flow. Second biggest challenge is the reach of the banks to people, that is including everyone in the banking fold. I am not going to the statistics. Some economists say 50% of Indians are unbanked. Someone says it is 60%, some says it is 45%. I leave it to you. In your own circle where you live or where you work, you can find so many people who are still not connected to the bank, who don't know what the bank is, they don't know how they can prosper, how they can take the financial benefit of the institution. We are privileged, we are living in a metropolitan. I have worked in that rural areas where reaching the branch in rainy days, I used to call for a small boat. You can think of what is going to be the banking facility, the utilization of the banking facilities by those poor villagers. Friends, if we have to take economy along, if we have to go for a long-term development of the economy, really going ahead as a social economy, we have to reach everyone. The fruits of the development has to reach everyone. This is the big challenge, and I request all of you, earnestly request you, if you get a chance to work in a rural area, please do work. You will have the real feel of the people, and you will feel that you are blessed that you are serving those people who are never being served as anywhere. Kindly don't stick yourself to the urban areas only. Wherever you get an opportunity, take a challenge, take a posting in a rural area. Then another challenge in the banking sector, which I feel as a practical banker is, yes, just in two points more. See, one question I will be asking you to find out whether in our financial system, do we have some policy mechanism how to correct the wrongdoing in the economy. Particularly, I talk about the banking sector. Because of the economic slowdown, the industries, they are not working in the right shape. They are not in the right financial discipline. There is no mechanism how to correct them, bring them back to the economic forum where they sustain, where they come alive. Find out, I will be very happy if you find some way how they can be taken out of this crisis. Deepak, just 1 minute I will put on. We have a high cost financing economy. Our deposit rates are high, our financing rates are high. That's why we have a hurdles. Globally, we are not competitive. We have to think over it, how we can make our economy as, low cost, low base, low fund economy, where the cost of our products are competitive for international market as well as for our domestic consumption. Now, Deepak, come to the China. I had an opportunity to work 5 years in China. Friends, it was a wonderful experience, but a very shocking experience also. When I landed into China, I went to meet Chinese banks. First bank I meet, Industrial and Commercial Bank of China, ICBC. Then I met China Construction Bank. Then I met Bank of China. Then I met another Communication Bank of China. When I saw their balance sheets, I was shocked. Individual bank balance sheet was bigger than the entire Indian banking sector. Our Indian banking sector, our entire balance sheets of the all Indian banks were $1.35 trillion, whereas ICBC balance sheet was $1.75 trillion. And all other were $1.5 billion. That means individual bank of China is bigger than the entire Indian banking sector. This is how the economic difference is between both the countries. So other things are explained to you. When one single bank is bigger than the Indian banking sector, then the economic size and their reach is already, before you can very obviously see how it is. Second difference what I found in China and India, particularly in the banking sector, most of the banks are government-based banks. Most of the companies, they are government-driven companies, government-backed companies. So the funding is very easy to be obtained there in comparison to India. Number 3 difference. The biggest economic challenge in India is infrastructure development. हर आदमी हम में से कहता है हमारा इंफ्रास्ट्रक्चर बेकार है. Our roads, our bridges, our power, our airports, railway, water supply, health supply, education, everywhere we lack, everywhere we feel we should have more funds, we can put it in a better way. What was the reason and what is the reason that present why we are not able to develop the infrastructure is lack of funds. Our Indian economy, particularly the financial sector, they don't have enough funds to fund such a big projects. because the requirement is very huge. We don't have such an infrastructure, funding institutions. Government is not having sufficient funds. Banks are not very keen to fund for very long-term projects because the power project, road project, other projects, they require funding anything between 7 to 15 to 20 years. Banking sector don't have asset liability matched to that extent. Banks do not accept deposits for 20 years, 15 years. So we are very, conservative in funding such a projects. Here, all our top executives of the nation has to take a call how to bring funds for these big projects so that we go ahead with the infrastructure, because infrastructure is the key for all other developments. Third difference, Deepak, I saw in China was the recovery mechanism. Nobody dared to default there, which developed the confidence. Yes, prior to 2005, their banks were in mess. It was not basically normal economic losses to banks, because most of the government companies who were borrowers of the government banks, they changed their the processes, they changed their, rather they modernized, they put down the absolute factories which were borrowed, used by borrowed funds. The government simply swapped from one pocket to another pocket, because the companies were government companies, banks were government banks, so they swapped all the bad debts on one platform and cleaned their balance sheets. But for an individual, for a corporate, it is very difficult to skip the bank, return of the bank money. Whereas in India, I cannot comment. Daily you read one or the other industrialist defaulting. Rather, 90% of the bad loans of the banks, they are contributed by less than 100 top business families. So it is not the poor person who is defaulter in the bank. This is the very big industrialists who are defaulter of the funds. Some strong mechanism has to be developed like China in India, where defaulters, they don't escape. Because the rotation of the funds back into the hands of the banks is the only key factor to put more for utilization of the people, to develop the confidence of the banks and develop confidence of the financial sector to lend more and more. I just conclude with this, only saying that it is not a gone case. The financial sector will revive. It is only the proper leadership who can visualize the possibilities, how the possibilities are there to revive the financial sector. Thank you very much. Rest I will take in the questions.
Yeah, thank you, Joshi sir, for your enlightening deliberations and knowledge which you already possess. In fact, when I joined in 82, I was given a mentor, S.K. Joshi, just to wind up, close the Punjab National Bank, London branches. So he really guided me. 8 years we worked in one branch, 2 years in another one, and every day we have been talking, and all knowledge has been gathered. I'll share with you. In fact, to meet him, there is a branch called Zirakpur in Bijnor, UP. I went. He had a rural posting there. Another person whom he taken over is now the country head of advisor to HDFC Bank, GS Kharbanda. When he was there, he's the country head of HDFC Bank. So, my dear students, don't be afraid of the rural banking. It's an unbanked sector. Rural also has its own merits. You can't absolve from the unbankable areas. This was the part 1 of our Conventus topic. Part 2 and part 3 is yet to follow. And now part 2 would be the corporate financial inclusion. And the only thing which we are left into the banking, for, my dear students, is a little bit we take a lead from the banks, financial inclusion for the unbanked sector. That is the Modinomics which is happening is JAM, J-A-M. J would be your Jandhan accounts which are going to be there. A would be the UID Aadhaar linked, and it has to be a process. M would be your mobile enabled. Believe me, ICICI Bank has opened a branch in an unbanked sector into Gujarat, and where all the lady farmers have been given this and a pilot projects which has only thing is the seed funding is still left. I won't take you through the innovations, e-technology, the e-KYC, which was talked earlier in the morning by our DG sir. Innovation, technology enabler, differentiator. Please add into this transformational differentiator, paradigm shift into the technology, which is there. Right from the morning we are hovering on this topic. Now coming to the last, which is left, is the women emancipation. Dr. Sharma has also touched about the microfinance. He has also touched about the financial income, Rashtra Mahila Kosh, and basically the NABARD schemes which are into the financial system. Now taking into the lead, thank you Zuchi sir for enlightening us, Manoranjan Sharma sir. Now we are, that was the major lead 1 hour we have taken. Because that concerned you right away. Because you will be getting jobs into the various banks. And the prospective jobs are going to come. First year students are going to get, straight away the SIP is going to come in for the banks. That is why I have not followed the 15-20 minutes time limit. But now, sir, as a moderator, I request you the second session, which is basically on the corporate, and a lead will be taken. I invite my next speaker would be R. Balachandran. He's an alum of IMI, and he's a partner and the national leader of E&Y. Sir, my question to you would be, coming from the corporate, you have traveled a lot. You have done a lot of alliances into the audits. So my question and my deliberation would be guide our students about the cross-border relationships for the sustainability opportunities which are going to be there, and how the industry is faring as on today. I'm not talking into, not the banking, but how the corporates are going to be faring and the financial inclusion role into it. So, sir, some 10 minutes? Yeah. I'm taking the liberty to curtail your timing. But if you want to go, take more, your wish, sir. Welcome, sir. If you want to come here, it's okay. If you want to
I'm fine here.
Yeah.
I'm fine here. Thank you, Professor Deepak, and hi, big hello to all of you. One thing that got missed out on the introduction was that I'm from IMI too. So there we are. So one amongst you. Thank you so much. Thank you so much. So tell me, how many of you all aspire to for a career in banking, insurance, financial services, and all out here? Wow, that's really a lot. So a lot of women out here too. So all the women can queue up at ICICI, Axis Bank, and Hong Kong Bank, and JP Morgan. And do you know why? They're all headed by women out here. So this is really exciting and great times. And the men folk are also kind of can't be left behind. We have Deutsche Bank out here. You know, just go here. They pay very well. Potential CEOs, Anshul Jain, all the way to Germany. So these are. Honestly, I feel that these are really exciting times for BFSI. There is so much happening. There is everywhere within our own firm. We have industry sectors, and FS is one of the big large verticals. So accounting firms traditionally in the olden times used to have audit, tax, and those kind of verticals, but now they're different. And the kind of verticals that we have now are more industry-facing, industry-led. And the one that does really well globally in our scheme of things is financial services. We just call it FS. That includes the whole gamut of banks, insurance, and all. Really interesting times. And I'm sure, with all that's happening out here. The only one bad thing that I keep hearing about in banks is this kind of stressed assets. But other than that, just leave that alone, because that's something that the system's got to deal with. But other than that, in terms of prospects, in terms of where we are in a state of economy, again, if we go to focus and talk about India as such, I think we should be, this is a rocking kind of a sector. There is so much happening out here. In banks, I can see, and Professor Deepak spoke about, inclusiveness with 22 crore new bank accounts. This is a real huge number. It transforms the whole landscape of banking. There is a lot that's going to happen. It'll open up a lot of jobs. And what kind of jobs will it open up? It'll open up kind of new, fresh thinking jobs, because they want technology to kind of drive all these kind of changes now. That's really something big that's happening. And within the financial services sector, I think a whole lot of players, they spend a lot of time, energy in this space. They don't want to be doing things in the way things have been carried out all these years. Many reasons, and one of them is risk management. Even if you want to manage risks well, you're better off using technology, you're better off using digital kind of, solutions than to try out things in the kind of old kind of, traditional ways. So huge transformation happening out there. Whether it is banks. So banks is clearly, a gentleman just said that it's just 50% penetration. So if you're looking at the other 50% unbanked, so there'll be another 22 crores or something that'll open up. So I think all the banks will have to gear up. All the banks will have to kind of, get in more people, more processes, more technologies, and to drive these initiatives forward. Let us look at insurance. That's even worse off. We have only 3% of this country who have an insurance policy today. Right? There is, it's amazing. It's about 3.4% in all. Life insurance is about 2.6. So that's the kind of. So I've kind of been watching the insurance industry for a while. Things are supposed to happen dramatically, and there was a period of time. Even if you look at numbers, figures, and all, and if you look at CAGR growth and all those things, you would see mind-boggling 25, 30% CAGR growth. Life insurance is growing this. Over a large period of time, non-life would grow at something like 18%, 16%. So what then this throws up is opens up a huge amount of opportunities. Almost every foreign big player wants a piece of the action out here. So they will all want to come out here sooner than later. We will have rules and regulations. They'll have to grapple with all those things. But all that will happen. So there will be a cap on 26%, 49%. We can keep arguing what is good, what is not right for the country. But slowly and surely, things will open up, things will kind of look up, and there'll be more insurance companies. And this 3% cannot remain 3% for a long time. The moment it goes up, you can imagine. As it is, I know that. There's so many jobs which are doled out by these big, large insurance companies, private sector players, as well as the public ones. If this 3% were to go to 6% and things like that, you can just imagine the number of kind of, what kind of opportunities does it throw up. Not just that, then there would be a lot of innovation that's taking place also. Not just those kind of traditional jobs. There would be kind of, people who would be entrepreneurs amongst you who will develop probably an app to bring more people into this fold. And so that's all those are kind of things that would be happening. So this whole inclusiveness initiative itself will bring in more and more people into the fold, which will provide lots of opportunities for you all. What more can I say? Another thing that I've noticed. I go to a lot of these Bangalore, Chennai kind of places, and a huge amount of in Delhi, Bombay too. Almost every foreign bank, do you know the number of people that they have employed? I was talking to one foreign banker. They said they got 40,000 employees out here, and they hardly have. It's hardly visible. There's another one that has 0 operations out here. Huge kind of building to themselves in Gurgaon. They have close to 20,000 employees in India. No, 0 operations, 0 lending, lease, 0 deposits, 0 everything. They got 20,000 jobs in India. So that's the kind of power of the Indian brain, Indian mind. And so Indians are traditionally, I think everywhere, we are considered to be good at good at numbers, good at number crunching, finance, accounts, debit, credit, processes, some amount of discipline. So I think just build on those kind of strengths that you all have. Huge kind of doors that'll open up for all of us. What else, Deepak ji? You said inclusive growth, cross-border. Yeah, I guess there would be a lot of stress in other parts of the world, but really don't let that concern you at all. India is kind of really rocking. CSR and sustainability, big, huge. There's lots of talk on that. I read some figures and facts and figures and all. This whole thing will grow only when the country grows, only when the sector itself grows. Once the sector grows, there's more money lying in insurance companies. And these insurance companies will drive investments into these sustainability areas, which are difficult to find funding. So it all augurs well for you guys. I think I tell you, good choice. Lots of things happening, lots of interesting times, and I just wish you all very well.
Sir. Thank you, Bala sir. You feel very proud that some alum on the top brass. And when I was surfing the net last night, looking into his PDF file of a research paper, he specializes into IFRS, that to the banking sector, which is going to come. And the government has already adopted the model. So we are proud of you, sir. And anytime it's your alma mater, you can always come back to us. And to take this more forward now, I'll just ask another alum. Right? He's from Deutsche Bank. Vimal, he's a banker, but a lot of banking has been done. But what he has done is lot of syndicated loans he has done. Lot of power projects he has done during his. And what I feel is that infrastructure financing, we are into now renewable energy rather than the thermal power. So that area, sir, if you can highlight and tell our students your key thoughts about it, your deliberations, how we should go forward for a sustainability into the thermal power. So I give you now 10 minutes, is okay? 10 to 15? Yeah, your choice. The panelist and Akash and Jigya, we will be able to finish max by 5:15, 5 to 5:15, right?
This now on. Yeah, perfect. No, it's good. It's good, right? Yeah. Perfect. It's really incredible to be back here. Yeah. The last time I was in this room, there was another eminent Sardar speaker here. His name was Montek Singh. And I'm happy that IMI continues its tradition of calling eminent Sardar speakers. I wanted to say one more thing before I begin on this one, and I would like to keep it interactive because although I'm sitting here, mentally I'm still there. These views that I share with you today will be my own, although they will be tinged with the experience that I've gained with the number of banks that I've worked for and the corporates. So let me kind of start with the fact that life is full of paradoxes. One of the paradoxes that most of you will face is that the weakest students will soon be bosses of yours. They'll be doing the best. And that doesn't incentivize you to not perform, but that is the, that is the reality. Right? Financing world is in itself also a paradox. Yeah. One reason that I say that is that if any of you go out today and ask for a loan for, and I'm assuming you'll be budding entrepreneurs, some of you, and you want to follow that passion of yours, you will find that banks will price it at the top end of the curve. Yeah, and 20 years down the line, when you're relatively successful and not just an entrepreneur but a businessman with long acumen, you will find that banks will run after you pricing at the bottom. So what it means is that when you need the money, it's expensive. When you relatively don't, it's not. There's a good reason for that. There is not, it's not unintelligent, it's not sensible. It is extremely sensible, but that is the paradox. Now, I'm going to focus on the sustainability aspect of this. Okay, so what do you think in terms of financing? If financing is itself a paradox, and on top of that you throw this phrase called sustainable, what do you think happens? Open question, one answer. I'm going to go for the girls first because they seem to be winning the most medals. Which one of you? Any lady here who wants to answer? What happens when you throw a paradox and you enter it with a sustainable phrase before it? Anyone? No. Okay. Let me kind of jump in here. It becomes even more terrible to fund. Okay. I'm going to focus on the energy sector. In the energy sector, in about 2005, I recall, renewable energy really came on its own, and renewable energy financing became a buzzword. Does anyone here know what is the cost of conventional coal production per unit on a rupee basis? Anyone here? I'll feed you the figures, but just wanted to check. Yeah. No, that's not conventional coal. That's what's more renewable. Okay, so coal is about 2 rupees 50 paisa a unit. Yeah. Wind is about 3 rupees 50 paisa a unit. Solar is between 4 to 6 rupees a unit. Now, all of you put your banking hats on. You know, you're all bankers, you work for various banks. You have a proposal that comes to you. One is from a conventional coal company which says it will sell power at 2 rupees 50 paisa a unit to the same buyers. And the other is a renewable company which says, I will sell it 4 rupees a unit. Which one will you back? So where is the model of financing then? How is this sustainable? So that is the conundrum that faces Indian banking, international banking, and sustainable energy. I'm again taking you back to 2005. Why did this sector pick up? And since the theme of the Finance Club is sustainable energy, I'm going to stay here and focus here. Tell me, the dynamics have actually improved. This gap between conventional and renewable has actually come down. At the time in 2005, it was wider. So why did it pick up? Who has the knowledge from the time that maybe they were in 6th or 7th grade about renewable energy? Anyone, 2005, why did conventional energy take a back seat? Why did renewable energy pick up? Ladies. Okay, guys, your turn. Anyone? No. It happened because of policy, right? So this is the second stream of thought I want you bankers to start thinking of is when things don't seem possible, why do they happen? It's because the government steps in, okay, starts to subsidize, starts to give money to promote industry. So the government stepped in. It said, I will incentivize wind. I will give them fast depreciation. Again, accountants within you will understand what that means. I don't expect everyone to understand, but I'll come to that. And I will give you incentivized tariffs. So I'll even pay you more to produce what is already expensive power. And people left, right, and center started to set up wind farms. One was to get the benefit of the high tariff. The other was to get the benefit of depreciation on their balance sheets, on the P&Ls. Suddenly, we had a rush of projects. And now we come to 2016, SEBs, Tamil Nadu SEB, Rajasthan SEB, these are the large wind areas, have stopped paying these projects. That's about 10 years. These projects take 20 years to, to close down. So Is government support sustainable? Maybe, it's true. Depends on which government, right? If maybe it was the US government, but if you're a triple B rated country and you're not even close to getting another upgrade, is it sustainable? So are you as bankers going to fund this sustainable energy program? So it's not an easy question. It's not an easy question on this side. I don't expect any of you to be able to answer it right now. But it's worth pondering on. And as maybe some of you, and not all of you, since I think many of you have chosen to go for banking, but some of you inside there are ticking entrepreneurs, yeah, potentially. Think about it. Power projects are not sustainable, renewable. Then what will work for a country like India? The answer has already been proven. I'm just questioning it to see if anyone can jump the gun and say it out loud. Does anyone have a clue what would a bank fund in such an environment? In sustainable energy? Okay, you guys really need to think or read up about sustainable energy. But the point is that I'm here to open your minds. So to kind of summarize a bit, my stance here is that if you come to a commercial organization, a bank is a commercial organization. We are in the business of making money for our shareholders. And that is when we're talking about an organization like a private bank. Public sector bank may not have the same compulsions, but private banks, global MNC banks, are in the business of maximizing shareholder value. So we are not in the business of promoting sustained energy or sustainable energy unless it makes a commercial benefit for everyone, for them and for us. In such an environment, my advice to any renewable or sustainable business is to take all the green funds you can get your hands on, because this green fund has its pockets in something called CSR. Even funds have CSR funds. So they will have a $1 trillion fund with a $10 billion green fund. So their objective is that some small pocket of mine should focus on sustainable development, which means that they are saying that we realize that it's not going to make as much money as we normally do, but this is for the benefit of the world that continues to revolve for another millennia. So to summarize again, my point was, if you are a sustainable energy developer in India, put your fingers around everything that is called green and lap it up, because it is not going to be there forever. Now coming to what a bank will fund. If, as you guys grow older and grow out, you will see that there is a number of areas or regions in this country which do not get power. Yeah. We're just very fortunate to be in an air-conditioned environment 90% of the living time that we have. But people don't have power. So those people actually can afford power, but just don't get it. And those people are serviced by entrepreneurs who have emerged from here. Colleagues of mine have quit to set up solar farms in UP. And these are not solar farms in the way that you will envisage. These are 300 panels, which comes in 30 square feet, which is, we're good. Well, we're good, but boys and girls, bottom line, sustainable energy financing for a commercial financial institution is a zero-sum game. It's not going to happen. You need to be either a multilat or a developmental agency or a green fund house to be able to fund sustainable projects. Yeah. Thank you.
Thank you, sir. Now, we come to the part 3, and we would be able to finish in time. Okay. How can we forget the regulator? We have a very senior government official from the Indian IRS, Indian Revenue Service, and he heads into the Deloitte. Now, Sanjay sir, I'll invite. Before that, the only takeaway I would say would be, I'm just reading it, what is the sustainability reporting? As on today, sustainability reporting is done by SEBI, mandated the annual business responsibility. This is called ABRR, responsibility reporting. And the framework is on the national voluntary guidelines of the social, environmental, and the economic responsibilities. These guidelines, which are there mandated, are basically driver forces for basically sustainable management. Last night, sir had sent me one of the project reports of his from WWF. 132, I was reading it 3 times, 4 times, 5 times. Then at about that, I made a concise summary. It's a beautiful report. It gives you all the deliberations of sustainability and your the corporate CSR, what are the financial inclusions, what is environmental, what is your social, and sir, 100% we will be able to adopt this report into our finance elective. I will do it into the project and infrastructure financing. The Triple P also is covered in that, and it's about 20-25 pages report. It's very, very relevant as on today. And though when you come into the second year, we have electives. Banali also teaches into private equity, venture capital. I teach into your project infrastructure financing. We should be able to adopt that. And CSR, corporate governance, is your core paper into BFSI. So there also we will be here. Now I'll call Sanjay sir to give his deliberations. He'll talk about more of the, from the government perspective, what are the tax laws, what is GST, how the inclusion, sustainability from his perspective, and your takeaways to the students. Sir, would you like to continue from there or here? Yeah, gotcha. And after this, we just have 2-3 questions, and after that, Bernali ma'am is going to give the total valedictory. Yeah.
Thank you, Professor Tandon. It's always a pleasure, and good afternoon to everybody. It's always a pleasure to talk to the very young minds, and I thought that I'll divert from whatever Professor Tandon asked me to do in terms of, talking about what you have so far heard. I want to test you on something very different. When the organizers called me 2 days ago and said that we want you to be this, I said, why me? Because I'm not an expert on finance. There are others, they're all sitting on the panel with very big credentials, and I'm feeling humble in front of them. But then I said, oh, it's a chance to talk to the very young people who are going to go into the market and into the real economy, and what are the challenges and what should they focus on? Then I said, let me take this chance and talk very differently, which is not even the regulator's perspective. I don't want to, because I'm no longer in the government, and I can't have the perspective of the government. I left it about 1.5 years ago. But then I said, the topic is, and that's why I carried this, it says, transforming the Indian financial system for sustainable development. And it's always the rare part which always proves challenge. Also the exams, whenever I took, were here or in Cambridge or elsewhere, I always found the last question to be most tricky one. So I said, let me handle that first. Okay? And that's why I said, let me define what is sustainable development. I'm not going to reinvent that definition. Sustainable development, as somebody said in 1972 at the World Earth Summit, is that it's about caring for the future generation without compromising the present generation. So nobody wants to compromise on the consumption that you're going to make in the present time. But while you do that, you need to also think of how do I sustain it for the future generation? And that proves to be a very big challenge. When you're making a tax laws, you always look at the income, your own consumption. No, each of us do that, my own consumption, and savings for the future, right? The same principle has been adopted by for the sustainable development. What you make certain income, you make certain GDP, you consume certain parts of it, and you retain something for the future. But what proportion of that should be retained for the future is the biggest question. We talked about, Mr. Bimal talked about the coal. I had a chance to be in the panel long ago in 1996, 97. Many of you may not have been born that time, on the fertilizer pricing. And unfortunately, fertilizer pricing remains where it is. And this is the biggest challenge that we have. And somebody said that, why not use coal? The coal is available in our own country, but we keep getting oil or gas for this. But then the coal was rejected as part of the whole analysis, because coal would give a lot more carbon in the system than what it will benefit. We will certainly benefit in terms of reducing our fertilizer subsidy. The other issues were, of course, that the oil or the gas fertilizer plant is much cheaper, so the capital investment is much lower than the coal, which is much higher, almost like double that at that point of time. So obviously, the issue of sustainability, it cannot be based only on the financial accounting. And this is where I would want to look at some of you as a budding finance person and joining the banks, etc., is not going to be based on the balance sheets. It cannot be. It has to have an economic appraisal, which takes into account the whole gamut of issues, how it impacts the people, how it impacts the project, and everything together. While it's very easy to look at the financial side, because the numbers are available, but when you look at the economic appraisal, and this is what I would request the IMI to start looking at it. There are no standard methodology for that, and the people spar on the financial appraisal. But I am yet to get a good handle on that, and which is where, and this is management, so I need to cover my head before I make that. This is where the public policy differs from the MBA classes. But nonetheless, you can't say that the economic appraisal is something which we can ignore. So that is point number one, which I would want to emphasize. That it has to be, if you want to attack sustainability, or you want to not address sustainability and achieve it in a foreseeable future, then you have to talk about that. You have to take this into account as and when you go into the system and you start talking about it. So financial stability, a financial system cannot work without looking at the economic appraisal, and financial appraisal is just a part of it. Now, I want to also address another issue connected to the financial, to the sustainability, and which is a very painful two items which I'll mention on a national level. One is about where is my total factor productivity of the country, which is basically talks about the inclusion of technology in my system, in my economy. And I am sad to mention here that the total factor productivity has gone down. That means we were better off at some point of time that the technology was becoming a part of my whole economic system. But of late, it is not. I'm also, the second issue is, where is my I-core, which is incremental capital output ratio? How much of extra capital that I need to achieve 1% of growth in the economy? Which brings me to the same thing, that if my I-core has moved from 4 to 5 or 6, then I have a challenge. How do I address that? I need to address it, not, and this is a finance class, maybe you have budding bankers, but there will be a large number of them who are engineers too. And I'm sure they are. I would want them to address the issues of technology. And that is something which this country, and I'm a proud citizen of this country, but I feel loath to mention that we seem to have forgotten. When you move into the banking sector or the jobs that you are aspiring to be, all of a sudden, and I'm not painting a very dismal picture, but it is a reality. This is a cost-plus economy. The jobs that you will do will be somebody else sitting in some other part of the world will be driving the technology, and you will only be a taker. And that is not a very happy situation for a generation which is, 60% of our, the population is below 25. And that is certainly a challenge before them, that they need to address the issue of technology, which will actually address the issue of sustainability and would put this country on a different league. Otherwise, we will continue to do this 5 or 5.5% of growth without doing anything. The balance, 1.5% or 6% or 1.2 or 5%, whatever we are getting, is an extra effort which we keep doing here and there. But if we want to achieve that 10% growth rate, where the government has set before itself, then the answer has to be technology. Various occasions I have given this example of a report which was published by, or an example which was published by The Economist magazine for the iPod. You all had iPod or something, which at some point of time, I think it was iPad, it will be one of them. But the clear point is that $220 was the cost price of that. 2.5% was the value addition in China. The balance, the 97.5%, and large part of it, almost like 60%, went to America. Why? Because they were the drivers of the technology. So what did the Chinese get out of it? 2.5%, which is the value addition, which is the income which came to China. But the volume of import versus exports were very high because the equipments came and equipments went out. We have talked about 1.7 trillion Chinese bank example. Good. And China has done very well. It is at a 10.3 trillion economy. But it could have done much better and would have been able to challenge the technology aspect of it, but that remains to be a mirage for them. At this point of time, the technological input in the US economy, in the German economy, were far more. And this is where the challenge lies also for China. I'm sorry to, contradict if I am doing that for some of my bankers friend on the panel. So the answer to that is technology. So far, the present government has tried to put some attention to that in terms of using digital technology for the delivery systems, Jan Dhan, JAM, all those aspects. But is that enough? Because when we talk about technology, we also have to talk about the manufacturing technology. And all our innovations or the startup companies has been in the digital media. All our Flipkarts have been on the digital media. This is very simple. But when you come to developing a new material, a new technology, an electronic system, or there will be failures, of course. But then the gains are far more. GE is not what it is today, but for Thomas Alva Edison. If Thomas Alva Edison had not produced all those patents, GE would not have been one of the top-rated technology companies. And it is still values technology. It does a large part of technology. They have a big research center in Bangalore, and try and get a job there. They will say, oh, what is your, they focus on the PhDs, they focus on the MTechs at the high caliber, and they want the technology people to be manning all those positions. Somewhere we need to start focusing it and not rely only on services, because services is fine, we're still not there. I mean, 56 to 60% of our economy is of services, but there is a need for a commensurate growth in the manufacturing. No contract R&D is good enough. No IT, ITES is good enough, because what you get is about 12 to 15% cost plus, and that is about it, which does not mean much, actually. So sustainability of the jobs, sustainability of the economy is not going to have that unless we start talking about the technology per se. And this is the biggest challenge. And this is, and as you, friends on the panel, as well as you go into the financial sector, you must start looking at the technology aspect. I need another 5-7 minutes and I'll be done. The third aspect, and which is where Professor Tandon said that the regulator's perspective, and I would want to address that from the tax point of view, which probably is my understanding. But coming back to it, can technology come from outside? No. Has ever technology transfer taken place? Very rarely. Most of the international agreements, be it a WTO, any of the MEAs, which is multilateral environmental agreements, or talk about anything which is there in the world. It talks about sustainable development, and one of the clauses will be the transfer of technology. And I have been a WTO negotiator as well as the environmental agreement and negotiators. You get nothing. You get nothing. They say that you pay for it, we'll give it to you. And developing countries like India and others, they find it very difficult to pay for that. So FDI is one way that you allow, and then people come and they set up their things. But do they bring the best of the technology? You have seen that we have not got an entry into NSG. Because we are not as, technology superpower house. They don't consider it as that we are at the cutting edge of the technology. If we had done that, probably we would have been knocking at the door in a much more definitive manner that we have been doing it today. And this is where one of the biggest challenge for the sustainability lies. Be it a North-North agreement, be it even a South-South agreement. In case of, I was one of the negotiators for India, Brazil, South Africa, what we call as the IBSA agreement. And Brazil told us they have Embraer as an aircraft. We said that, why don't you set up it here? They said, no, we don't want to do that. They will want to go to some other place. So ultimately, they said that we have invested a lot over a period of time. And we don't want to give it to HAL or somebody else in India to make the planes. So IBSA agreement remained a bond, still bond agreement. It couldn't prosper because of these issues. So this is one aspect. Now, so where are we now? can the government fund the technological developments? They have a big role in that. They have certainly a big role in that. But where is the money? Close to about 80% of the budget is a committed liability. Interest, subsidies on food and fertilizer, and of course the defense. So where is the money then? So there is a very little fiscal space for the government, which we call it the budget on 28th of February. We keep talking about that and making a little bit of change here and there. The government salaries is another one, which is a committed liability. So the government has very little space. And it's good that the GST, in the most suboptimal form that it is trying to come in, is coming now. And we have to see how it spans out, because if you see GST, it's considered an ATM machine by most of the countries, because it can give you a lot more money. In fact, people often say, oh, if GST is a regressive tax, because it taxes the poor as well as the the rich people at the same level, on the consumption basket, and at the same level. So the percentage of the income that a rich man gives for the consumption is much less than the percentage that it gives is given by the poor people. So it's regressive. But despite its regressivity, it's a very good tax because it gives you a lot more taxes. The progressivity aspect can always be handled through direct taxes or some other forms. So that while government can attend its social justice issues or social equity issues through the direct taxes, the ATM machine has to be nurtured and did well. But we have so far been fighting on the state versus center, and the big reason for that is that the GST is basically a unitary tax, is not a federal tax. Because if you see the example of Canada or Brazil or any other federal system, there have been compromises and compromises in that. And so India is also doing the same way. But good that we are ultimately having some form of GST, which just brings the goods and services, which will bring down the cost of doing business. But more important, through the technology, if you see that the example of Korea in 1980s, if their producer price index was here, today it is here. They have just reduced with the help of technology everything, and then created a lot more money which they can invest abroad and bring the payments from abroad to their own country and become rich. So while the taxes are important, the government needs to create a lot more. At the moment, I think the budget size is about 16 lakh crores, which in terms of taxes is only 16 to 17% of the GDP, which is very, very low. Even our own neighbors have it around 22%. So to climb that, we need to add 5% more of taxes. And I hope that happens so that the government can allocate a lot more productive assets or productive money to the development of technology and to, 2 minutes. Now I'm on the. So I felt that we need to answer all these questions together. And it is, people who are aspiring to be bankers, you can find your niche, what you plan to do it. But it is very important for somebody who is an engineer turning into banker to bring out a different methodology to support a particular project and bring sustainability to the whole aspect. There's a space for the fiscal space is much more compromised from the government point of view, and the government, despite everything, because the numbers are also growing, the challenges are growing, they will have a very little space. So you have a challenge in terms of technology, in terms of looking at the whole appraisal issues in a very, very different framework. And this is what I wanted to convey. Thank you very much.
Thank you, sir. Now we have got time for taking 2 to 3 bullet point questions. You can spare them to any of the panelists. Mike.
You have a column, I guess.
No, I don't need.
Good afternoon, sir. Can I? Yeah. So my question is there a lack of political consensus to address the issue of NPS? Because it, as per the statements mentioned, it keeps on happening, like it's a kind of vicious cycle. And it did happen in 1990s, and it did happen, it is just, the country is facing the issue right now as well. Lack of political consensus, because it is a problem which is there with the high net worth individuals, because one of the panelists even mentioned that it's with just the 100 people, who are facing the issue. I mean, the 90% of NPS account for them. So how can we deal with that apart from just the recent 6 months before, the government had come up with legislation that the banks can recover those NPAs. They did come up with something like that. And my second question is regarding the kind of capital infusion, required. Isn't privatization of public sector banks a solution for the problem apart from M&As? And what are the issues, that the PSBs face in privatization, apart from the, the employees that are not agreeing to that?
What is the good name?
Sparsh. To Sparsh.
Question can be taken by Zushi sir or Sharma?
Anybody, sir.
Yeah, anyone. One each, sir. You can take NPA.
You will add, I will just start. My senior colleague will add wherever I will leave. Dear, see, all solutions in our Indian economy, this is my personal view, not from anybody else. All our decisions in this economy are taken politico-economic solutions. So it has a politico-economic solution, they will find it. About, top people holding NPAs, some drastic has to be done from the government, and I'm very sure if you are following the newspapers, right from top of the country to our finance minister, everyone is writing so much about it that they will not leave anybody who holds the public money. Because my money is merely public money. It is your and my money.
Yeah.
Nothing is there, beyond public money. So they are on the issue. But the complications are too much. Realizing money is a big issue. I give you a small example. We even hold a very good securities in certain cases. Selling off that property to realize, bank money is again a problem. There is no buyer at the moment for buying that outrightly. And if we sell them, lower our loan commitments, the big haircuts are to be taken. Who will take that haircuts? It is a very big decision. Some very strong mechanism has to be there. Some protection to the bankers has to be there to take such a drastic decisions. That is your number one. Number two, changing financial, commercial, government institutions into a private institution. It has own implications. The most complicated implication which I foresee is, as on date, all government banks, they are working on a socio-economic environment. Our 90% decisions are social decisions, 10% are commercial decisions. But once we privatize, all our stakeholders, they will look to the profits. They will look to the bottom line numbers. which are not very healthy for the banks. That is going to be the biggest issue. Rest, other unions and staff and others, that is the common thing that can be addressed. Sooner or later they will adjust. But how to adjust from social banking balance sheet to commercial banking balance sheet, this will be a big challenge.
Well, I agree with most of the points made by Sri Jutshi. I'd like to supplement if NPA is a very complex issue. It is due to internal factors, it is due to external factors. Without going into the details of the issue, let me give you a few stark examples. How it can be the result of some policies, some global issues. For example, you find that the steel industry is in the doldrums all over the world. In India, we find a particular, the severity of the problem is of much greater degree because of huge dumping by China and some other countries. So there are certain factors beyond our control. Of course, there could have been better monitoring, better project appraisal, post-disbursement supervision, but there are also some macroeconomic factors which are beyond our control. About the convergence on the differences across the party lines, convergence in thinking on change in the makeup of banks to greater private equity participation. Some such things are already in the offing, but the government has made it repeatedly clear on the floor of parliament, elsewhere, that under no case, in no case, the equity holding of the government would fall below 51%. Most banks now it is between 60 to 70%. Apart from that, having said that, there are several welcome developments. If you've been following the newspapers, the sessions of parliaments, in the last 3 months, there have been some very welcome development in the sense that the SARFAESI Act, which had come as a big boon, that has been strengthened, that has been given much more teeth. It has much more stringent provisions. In some states we call the district magistrates, some states we call the district collectors. They have been given wide-ranging, sweeping powers, and those decrees have to be enforced within 30 days. This is just one example. There are several other measures which give far more teeth, far more stringency to the. Similarly, you'd be aware that the bankruptcy code, which is on the lines of the code passed, which has already been in existence so in US for more than 30 years, has already been implemented. So taken together, these are very welcome developments. As long as banks are there, there will be some element of defaults, there will be some delinquencies, but as long as the thing is kept within manageable proportion, I think things should be acceptable. Thank you.
Yeah, any other question?
Sir,
your name? Yeah.
I am not from the banking sector, as you already know. But I was writing a chapter on the tax collection for the Tax Reform Commission. And in that, I did a lot of, and looked at a lot of laws which is prevalent in the banking sector in the other countries. And one of the point which came out, and which is what I would want to say, is that don't follow the debt, follow the debtor. That is the key point. You may keep following, and which is also true for the income tax, tax department. Tax department, particularly let's say in income tax, they collect about 7 lakh crores, and 5 lakh crores is a debt, tax debt, is the area which has not been paid. So the question of these NPAs and the debts not being followed is almost the same between the banking sector and the tax side. Having said that, the second point, which most of the other countries have done, they have used the data analytics and brought the predictive analysis as to go ahead of it and find out who actually is going to default. So you go ahead of it and you take care of the NPAs. Things like that has to happen. Whether something like this has happened in the banking sector, I'm not really sure.
No, new things have come, willful defaulters have come, joint lender forums have come, then the provisionings have been made. So there are a lot of things the government is doing. Now the next question, sir.
Sir, I'm Rishabh. Coincidentally, I interned in a bank, and my mentor always told me that fintech companies are the next thing, the future. So my question is to Bimal sir, so how would banks or other financial institutions leverage on technology and reduce that vacuum for funding all those projects?
So to kind of rephrase your question so that I understand it properly, you're asking whether banks are going to leverage on fintech companies to reduce the cost of operations? Is that the question? Undoubtedly. Undoubtedly. I'll tell you, banks have hit a point, and I'm only referring to international banks, where they've found that revenues have hit a standstill. And if they are to increase shareholder value, they have to focus on costs. Okay, so we are looking at opportunities to work with companies who will help institute new technologies to reduce our back-end costs. It's not very apparent to any of you here how intensive banking operations are. Any intern who gets absorbed into a bank will spend a year in the back end to understand a bank, how it works, so that when they come to the front, they know exactly what they're taking on when they promise business to a client. So I don't know if I've answered your question in its entirety, but fintech companies are also a challenge to banks, right? I'm presuming you understand that many of them are now stepping in and delivering products that banks are already been delivering for over a lifelong, generations, and they're doing it much more efficiently. So the challenge to us as bankers is to figure out whether we need to compete or need to exit. At present, we're so well entrenched that we're competing, but I would say that the way these people are so efficient and so nimble, it's becoming increasingly difficult to compete with young minds.
Yeah, I think we don't have time, but I'll share the email IDs of all the panelists. So if you still have any questions, you can shoot the mail, and I'll request the panelists to please exceed. Always, because for us, at this age, you are important. You are our customer, right? That's our KYC and KYE. Now I'll request my senior faculty member, Dr. Barnali Chakladar, to just sum it up. And I thank all the panelists personally for sparing their precious time and coming to IMI and deliberating their knowledge, aspirations, and you all have been a wonderful audience. Thank you, and Barnali ma'am.
First of all, I would like to thank Professor Deepak Tandon for calling me a senior faculty colleague. And then, after that, I would like to thank the organizing committee to, let me give the vote of thanks to such distinguished panelists. Practitioners, visionaries from the financial sector, from the corporate world, from taxation service, policymakers who are here to share their views with all of you. And, it's always an addition to whatever you learn in the classroom, a good supplement. So thank you very much, all the panelists who have taken, of course, time from their busy schedule, and that goes without saying. And it's a very standard line, thank you for taking time from your busy schedule. But I would really thank all of you for really taking out half a day, more than half a day, because traveling in Delhi also takes another half. So it's almost a full day, and spending time with all of you. And I could see the the sparks in your eyes when you were actually giving your practical inputs to these students, and it was really good to see that they are on a listening mode when they are in front of practitioners like you. In front of us, I don't want to comment. Okay. So I thank you, Dr. Manoranjan Sharma, sir. You ran us through the process of financial reforms done during the previous few decades. And we appreciate your optimistic view about Indian financial sector. You're highlighting the possibility of becoming demographic disaster from demographic dividend is indeed thought-provoking. Thank you, Mr. S.K. Jutsi. We appreciate the way you shared your experience and knowledge on Indian banking sector and its opening to the global world also. And your views on practical aspects of banking are commendable. You emphasized on growth of banking sector despite the challenges like regulations, fraud, stringent norms because of Basel and particularly the risk-weighted assets, etc., infrastructure, etc. And it is really important, what you said is really important for all of us to find ways of making our financial products globally competitive. Thank you, Mr. Balachandar. Thank you very much. And I keep on, hearing that Bala sir from Ernst & Young, and I'm so happy to meet you today, and thank you for coming. Mr. Balachandar, your speech was so very motivating and so very positive, and your suggestions on more and more use of digital solution for transformation is well taken. And thank you. You mentioned that inclusiveness of more and more people will create more opportunities. And last but not the least, your inputs about sustainable development in the sector is well appreciated. And let me also thank Mr. Bimaldeep Singh. Mr. Singh, you said something, you mentioned about the paradox of pricing loan. Paradox of pricing loan with high pricing when it's a startup. And then chasing the person when the person is a successful one. That really, this is really a thought-provoking sentence that has come from Mr. Bimaldeep Singh. Because maybe that is the reason, why 60 to 70% of the loan in a bank's balance sheet, you will find to top 8 to 10 customers. And that is the reason why, there is so much of default and NPAs, because you are actually concentrating on a particular segment with 8 to 10 concentrated customers. This is exactly Mr. Bimaldeep Singh said, and he said it's a paradox of pricing of bank loans. Thank you so much. And you simplified the government policies. That's the best thing about it. You simplified the government policies and policies on financing of sustainable energy, and you gave brilliant practical examples. Your advice to sustainable business about taking green fund is a win-win one. Thank you very much. Thank you, Sanjay Kumar sir. Thank you very much. Thank you for throwing the question about balancing between consumption and passing it on to the next generation, to the future generation. It's a brilliant thought. He said that, we have to consume in the best possible way, and also we have to pass it on to the future generation without compromising on our consumption. So that itself says, that it is a very difficult task. It's easy to say, but it's really difficult to balance it. And thanks for broadening the horizon by moving ahead from balance sheet and moving to social and environmental aspects. Thank you very much for bringing in aspects of technology transfer, which actually doesn't take place free of cost. So you were, I think, emphasizing, you were wanting to emphasize on transfer pricing policy for technology transfer, maybe. And thank you so much. Thank you all the panelists, and we hope to see you again. Thank you.
We can't look at the financial growth as a standalone. We must look at the bigger picture of sustainable development, leveraging it with the technological advancement and incorporating the demographic dividend that is the USP of our country. On behalf of everyone present here, I express my sincere gratitude to Mr. R. Balachandar, Mr. Bimaldeep Singh, Mr. Manoranjan Sharma, Mr. S.K. Zutshi, and Mr. Sanjay Kumar for taking time out from their very busy schedule and sharing their thought-provoking insights with all of us. Thank you for the valuable knowledge that you have imparted to us through this discussion. I'm sure that we shall keep in our minds all that you have said and imbibe in our knowledge into our decisions as future managers. I would like to take this opportunity to thank Professor Deepak Tandon for consenting to be the moderator for this session and conducting the session in a highly coordinated manner.
Now we would like to present the distinguished speakers for the session with a small token of our appreciation. Mr. R. Balachandar, sir, we were honored to have you here with us today. May I request Professor Gauri Shankar to kindly present Mr. Balachandar with a memento as a token of our appreciation. Mr. Bimal Deep Singh, sir, we were honored to have you here with us today. May I request Professor Prashant Gupta to kindly present Mr. Singh with a memento as a token of our appreciation. Mr. Manoranjan Sharma, sir, we were honored to have you with us today. May I request Professor Aman Srivastava to kindly present Mr. Sharma with a memento as a token of our appreciation. Mr. S.K. Zootsi, sir, it was a privilege listening to you. May I request Professor Deepak Tandon to kindly present Mr. Zootsi with a memento as a token of our appreciation. Mr. Sanjay Kumar, sir, it was a privilege listening to you. May I request Professor Barnali Chakladar to kindly felicitate Mr. Kumar with a memento as a token of our appreciation. Professor Deepak Tandon, sir, we were honored to have you with us today. May I request Akash Gupta, Secretary Finance Club, to kindly felicitate Professor Deepak Tandon with a memento as a token of our appreciation. I request our speakers to kindly sign a mug and write a short message for us to keep as the memoirs of Conventus 2016.
Ladies and gentlemen, with this we conclude the session of the Finance Summit. We are sure that the session has been very enlightening for each and every one of you present here. On the behalf of Finance Club of IMI, I would like to take this opportunity to commend all the guests, participants, speakers, professors, students, and staff of IMI for making the session an unparalleled success, as well as the media persons for covering the event. We would also like to thank our sponsors for helping us in this endeavor. Our sponsors are co-sponsor RP Sanjeev Goenka Group, powered by Panasonic smartphones. We would also like to thank our partners, nutrition partner India Gate, food partner Pat and Harry, food partner Burger.in, beverage partner Hector Beverages, website partner Acunity Software Private Limited. Also, may I take the opportunity to thank our sponsors, American Express, CADB, Respite Holding, Safe Pocket Money, NTPC, Allahabad Bank, Pizza Hut, and Punjab National Bank. Thank you all. We request the guests to proceed to the lobby area for snacks and refreshments. Students are please requested to stay back.